I guess we've all been waiting for this precipitous decline in retail spending. Waiting for that cliff edge where everyone suddenly stops going to the shops, and it hasn't kind of happened that way. If you look at the reporting season in isolation, EBIT across our universe was just over 3%, 3.4% better than we'd forecast it to be, and share prices responded positively to what was generally pretty positive news. If you look at the sales performance over reporting season, on average for our universe of stocks, sales were up 9.3% year on year. That's obviously ahead of the rate of CPI and really doesn't speak to a sector that's undergoing particular stress, if I'm honest. So where is it going to come from? At the moment, demand seems to be consistent with a relatively soft landing scenario. Clearly, we've got CPI, which has come down now at 4.9% in July. We've had the RBA on hold now for 3 months in a row. And if they do go again, the expectation is maybe it'll be for the last time. So, excuse me, at the moment, it seems as if the consumer is still out there spending. It's not to say everything's easy. It's clearly not the case that everybody has lots and lots of money to go out there and spend. But Accent, when they came in, said, our best selling products are our most expensive ones. There's still a cohort of customers who are out there wanting to spend money on the things that they want to spend money on. And why is that? Well, because unemployment is at 3.6%. So even if the essentials are costing more, people still do have cash coming in. Unless we see unemployment spike up and there are people that just literally do not have money coming in the door, you are going to be in a situation where there will be people who will spend in discretionary retail channels. So reports of the death of discretionary retail are greatly exaggerated. Yeah, well, gross margins were better than we expected them to be in reporting season. On average, they were down 30 basis points across our universe, and that was a little bit better than we'd forecast them to be. And most of the companies we spoke to said, actually, we think that gross margins are going to be held reasonably stable. And of course, companies who are prepared to say our margins are going to be stable at this very early stage in the year are probably erring on the side of caution, and there could be some room for growth. Now, why is that? Well, international freight, which is a big proportion of the gross margin, because obviously we import pretty much everything that we sell through this channel. That's come way back down below pre-COVID levels. On top of that, you've got an indication from a number of retailers that they're seeing supply chain deflation. So their suppliers in China and other parts of Asia are actually reducing their prices. And that clearly is going to be helpful. It will flow through into offering a keener price to consumers, and that will support a gradual reduction in inflation as well. So gross margins look as if they're going to be relatively stable. However, operating cost inflation is inescapable. If you look at wages, this is the big one, particularly if you're a bricks and mortar retailer. Of course, you've got an awful lot of people that you're employing. Now, they are going to go up. The General Retail Award was for 5.75% increase in the minimum award to an adult in this sector. On top of that, you've got the superannuation guarantee going up by 0.5%. So everybody's on 6.25% increase in unit wages. So that is going to flow through into compressing EBIT margins. So my expectation is that while gross margins will be stable, we will see EBIT margins decline over the course of the next year. Yeah, well, I don't want to be, I don't want to come across as being overly positive because the environment isn't that great. It is going to be subdued. We're not expecting to see significant amounts of growth in retail sales over the next few months. It will get better as the year goes on because the comps get less challenging. So we start with very negative like-for-likes, but they will start to improve. And most people are talking about maybe the second half of this financial year and coming into FY25, we're going to start seeing a little bit more positivity in terms of the earnings performance of these companies, but it has been quite resilient. But in this subdued environment, what you need is a company with good brand equity. You need a business that can grow by taking share from weaker competitors. So these are the people that don't have to discount so heavily, because why would you? They're the people that can grow and open new stores because, again, there's an opportunity for them to do that. So if you have the ability to grow in this sort of environment, largely through the store rollout program that you might have, that is going to genuinely expand your business for the long term. And that is the sort of business we want to own. On top of that, you need to have good cost efficiency. You need to be able to look at your roster and say, how can I reduce hours if I need to, if the footfall reduces? How can I get efficiency through my supply chain? How can I ensure that I'm as efficient and cost effective as I possibly can be? So companies that are well run with good brand equity and have a growth strategy that doesn't rely on retail sales generally rising are going to be the ones for us. And so, I sound like a stuck record, but of course, Lovisa is absolutely top of the list here. The store rollout will continue at a similar pace to FY23, despite Victor's prevarication. It will be around about 200 stores. Why would you slow down now? That will continue. They have an extremely efficient store format as well, so there's no reason to think the costs will get out of control. On top of that, we've added Accent to our list of key picks. That's another Brett Blundy stock, and you may have seen the news that he's just reduced his stake in Accent, so you might see an opportunity with the shares going down today in response from that. But nonetheless, the cost control that Accent has is extraordinary. They have more stores than Lovisa, would you believe? And they're only in Australia and New Zealand. And they're seeing no signs of a slowdown in that store rollout. So they've said another 50 stores this year, or probably more like 80 or 90. And then Beacon is the third one. And you may say, well, why talk about Beacon? It's a cyclical business. It's a subdued market. But what we're looking for is companies with strong brand equity, which Beacon clearly has, but also with a growth opportunity in a subdued market. And of course, Beacon moving into the trade business, which you've heard me talk about on a number of times before, is that opportunity. It's a $3 billion market. They have 4% market share. If they can grow that, it's going to grow the business regardless of what happens to the rest of the retail sales market. So, this is a slide that just shows you the EBIT beat or miss against the share price reaction on the day. So you can see the companies that, generally speaking, everyone was in the positive quadrant there of beating our numbers and seeing the share price go up. Accent is the one that really did have a great share price reaction and did beat our numbers in terms of EBIT. I think expectations were relatively low. The stock had been reasonably weak coming into the result. But really what surprised people on that day and surprised me was their cost control. To improve their ratio of cost of doing business, or OPEX to sales, in the second half versus the first half was something we didn't see from any other retailer. So an extraordinarily strong cost performance by Accent, and that did surprise me. Obviously, Supercheap and JB Hi-Fi are also extremely strong at cost control. They both beat my numbers by 7%. You see the shares went up. Super Retail paid a special dividend as well, which wasn't a huge surprise, but was certainly a positive signal. And so they were positive surprises. And then, of course, there are a couple that surprised us on paying a dividend. So the Reject Shop came back to paying dividends for the first time in years. And it was a very big dividend compared to our expectations, a little bit of catch up. And then Step One, everybody's favorite online underwear retailer, paid a dividend which nobody expected them to do. And have said that they continue or will continue to pay at around about 100% EPS payout. So that was a positive surprise too. On the negatives, you can see poor old Adairs there in the bottom left quadrant. They surprised us by cost overrun largely, by sales being a little bit weaker than anticipated, but largely they surprised the market because they cancelled their final dividend. And of course, what we've been saying for Adairs for a long time is that, look, it's not a bad business. I think it's got some challenges, but the one thing you have got is a magnificent yield. It's magnificent until they cancel it, and that's what they did. So they will get back to paying dividends in February, I have no doubt, but it was certainly a negative surprise on the day.